your screen. Aha. It's better now. It's going now. If you can see my screen, please let me know.
I can see your screen.
Yes,
Okay.
I can see the screen.
Yes.
Okay, so I understand my colleague was able to take chapter 4 with you the other day.
Yes, sir.
Okay. So we are going straight to chapter 5.
Honestly, I'm unable to see your screen. Oh, I can't see your screen, sir. I can't see.
You can't see my screen?
Oh,
Can others confirm they can see my screen?
Yes, I can see it.
Yes, I can.
Okay,
I
if you
can't
cannot
see
see my
your
screen,
screen.
you
I
will
can't
need
see your
to
screen.
log out and come back again. It might be
Good evening, sir.
good evening, welcome. It might be network glitch from your end, so you just log out and you come back, and I believe you will see my screen. So without saying much,
please, before we start, and please let's
okay.
reduce the interruption, guys. Let's reduce the interruption so that the class can be productive. Can you start, please? Thank you.
Okay.
Please, can I ask a question before we start, please?
Please go ahead. Ask the question. We are hearing you, please.
Okay. I wanted to ask if the class is being recorded, because I missed the class for chapter 3, that is obtaining an engagement, audit engagement. I missed it and I couldn't find the recording, probably on YouTube or something. So I don't know.
The class was not recorded.
That's my question,
so
sir.
I believe this one is recorded. Yeah. This one is being recorded, yes. Can we proceed now?
Yes, sir. Yes, thank you.
Okay. So please do us a favor to mute your microphone and off your videos so that we are able to move fast. So we are talking about chapter 5 today, and this is audit planning and risk assessment. So your traditional definition of planning has not changed. Like someone will say, if you do not plan, you are planning to fail. So it is with the auditor. When you want to carry out an audit engagement, it is just expected that you are able to plan effectively for that audit to be able to be carried out very well. You have to plan around resources, you have to plan around timing, you have to plan around the scope of work you are going to do. So planning is at the heart of audit, just as you plan your daily activities for every day you go out for work. So having an audit engagement or an audit assignment also require planning for you to be able to achieve the main objective or the main goal of that audit. And which we all know that at the end of the day, what the auditor wants to do is to be able to pencil out an opinion as to whether the financial statement show a true and fair view. And this is not something you can do like a magician. You cannot arrive at that opinion like a magician who can just cast a spell and is able to tell you that, okay, XYZ exists or not. You have to do some certain things, and these things are procedural. And for the fact that you have to follow procedure to arrive at it, it is necessary that you're able to plan. So you will plan with respect to who will do what, and when and where will something be done, or some work or the work will be done, and the broadness of the work, the scope of the work. So those are major 3 key components of audit planning. So We'll also be looking at the other side of the chapter, which is talking about the risk. And we understand that for every business will come with their own inherent risks. The risks we are talking about here are risks that comes with the industry the company operates. Then we could have control risks. We could also have detection risks. So as we proceed, I will tell you what you can see to know which type of risks that you're expecting in that regard. So by way of maybe introduction and definition, they say everything in life starts with a plan. Same with audit assignment. Just like I said, that the way you plan your day, that is how an auditor also plan his work. A plan set out what needs to be done to achieve an objective. So that is just what you need to know about planning. Setting out all you need to be done, all that is need to be done to achieve a certain objective. So the objective of an external audit is to reach an opinion as to whether a financial statement show a true and fair view. This is so summarized definition, but you build on it and you're able to satisfy the examiner that yes, you have read and understood the chapter very well. So an audit plan should be prepared as a means to achieve that. The content of an audit plan will contain usually who will perform the audit work, that is the staffing. How many number of staff do you need? What are their qualifications? We have discussed this in obtaining an engagement. You have to look at the necessary resources in terms of material and human resource with respect to the work on ground. When will the work be done? That is the timing. It must have a time to start and it must have a time to end. And you usually will issue your report at the end of the audit. So if audit does not exist in perpetuity, it has a time frame when the auditor start the field work, and after the field work, they are able to do their probably interim reports and the final reports. So the interim reports provide an opportunity for the management to be able to respond to certain issues they think they can be able to respond and maybe change the outcome or better the outcome of the audits. Then the final reports give the final verdicts of the auditor as regards to the financial statement, whether it represents a true and fair view or not. So what work is to be done? What are you looking at? Is it going to be 100% audit? Is it going to be a sampling kind of audit? Or are you going to just audit once? Is it an asset verification? What kind of audit are you doing? So you have to look at what you're going to do. And as we progress, you also understand that sometimes the auditor will need to set materiality threshold to be able to guide his focus as to what is important to make a judgment around, or what is not important. And what is important with respect to audit is whatsoever any misstatement around it will cause the outcome of this financial statement to be misrepresented. So you could just jot your question whenever we stop. I will give some room. I will give like 15 minutes so that we can be able to brush together to see any aspect that you could have questions. So risk assessment. In order to prepare a suitable audit plan, the auditor needs to have an in-depth knowledge and understanding of the entity and its environment in order to assess the risks attached to the audit exercise. Risk assessment is an important and key feature of audit planning because it affects the amount of work to be performed and where to focus on. So for the fact that the auditor will understand the environment to which the client exists or operates, The nature of business is also very important, because these are all information that will give an auditor focus as to which aspect he will focus more to be able to unravel any kind of misrepresentation. And as we proceed, you will understand the mind of the auditor, the questioning mind of the auditor. So in the nutshell, planning is important to all assurance engagement, including non-audit assessment. So it is just, there is no exception. Just like I said, that life itself, if you do not plan, then you are definitely planning to fail. So it is not just audit of financial statement that require planning. Even if it is a non-audit assignment, whether it is an assurance assignment, you are still expected to plan. Of course, you will plan who work on engagement, you plan the timing and also other resources that may be required. All this must be done. So planning to audit is like day and night in anything that you do. They must be present, whether you like it or not, for you to achieve your goal or objective. So professional skepticism, according to ISA 200, requires that when performing an audit, auditors should adopt an attitude of professional skepticism, which is defined as an attitude that includes questioning mind, being alert to conditions which may indicate possible misstatement due to errors or fraud, and a critical assessment of auditors' evidence. So what we're saying is that do not just accept everything given to you hook, line, and sinker. You should open your mind and be able to review every information presented to you. We are not saying that the auditor should not believe the staff or the management based on the information they provided, but in as much as you believe them, also have your mind open that anything can happen. And if your spirit suggests that you check any document, you should be able to make a review of them and have your own view around it. Don't just accept everything that is given to you and think it's okay. Of course, they say not all that glitter is gold. So you don't just go to an audit with a mindset that whatever the management gives to you is fine. You should be able to verify documents. And of course, one of the ways that you can actually ascertain the validity of every transaction is at least when you are able to see that they pass through the bank statement. That gives a comfort. And when you are able to see that, yes, they follow the procedure as to internal control that has been set up. If you see the way ICANN has arranged this book, you would understand that everything is following each other. And if you understand it in that way, this course will be at your tips. Because we discussed obtaining an audit engagement in chapter 3. Chapter 4 was internal control. And now we are discussing audit planning and risk assessment. You can see that there is a relationship, there is a correlation, direct correlation between these chapters. So just try to understand this in this direction and marry it together. Then this course will not be a difficult one. So this does not mean that auditors should disbelieve every single thing they are told, but they should view whatever they are told with a skeptical attitude and consider whether it appears reasonable and whether it conflicts with any other evidence. In other words, they must not just believe everything the management tells them by on the face value. So that is just what I said before. We are not saying you should believe everybody in the company, but we are saying that if you think that information that is passing through to you, you should be able to review them, then we are saying you should have your mind open to check things, even if it's at random. Make sure you check things. Everything that suggests to you that could cause a material misrepresentation or misstatement in the financial statement, please, it is advised that you query it to the latter. So, not because you were told that Mr. XYZ was sick and the check was signed from his house and you don't want to inquire further details or history around that transaction and you decide to take good. No. Open your mind and inquire more. Inquire more. And most time it is advised that you try to make your inquiries in writing so that there are evidence to file. So according to ISA 300, planning an audit of financial statements is to plan the audit work so that the audit will be performed in an effective manner. Adequate planning benefits the audit by helping the auditors to devote adequate attention to important areas of the audit, helping the auditor to identify and resolve potential problems, helping the auditor to organize and manage the audit engagement so that it is performed in an effective and efficient manner, assisting in the selection of appropriate staff for appropriate audit work, allowing for direction and supervision of staff. So, in a very simple way, these are importance of audit planning or significance of audit planning. So if I were you, I can just underline this in my pack or make a highlights. Well, this is a question can come around this. And if I want to believe that after we have treated any chapter, you are able to go through your Pathfinder to check the way, the mode they ask question on a particular chapter. And the way to do about this, at least you should compare 3 years, 3 diets, 3 to 4 diets, compare and contrast question on each chapter. It will give you an idea. One thing I tell people is that if you do not check your Pathfinder question, you'll be very surprised that when you get into the exam and they give you an audit question, you will be lost. It will be a very simple question, but you will not know where they are coming from. So at every end of every chapter, it is expected that a serious student will take a look at the questions. It's very important. The examiner also recommends that you use the study question for your practice. It's very important. So I'm encouraging you. The Pathfinders are soft copy, and Apex has also shared a copy of the questions on the platform. So do well to download them and try to familiarize yourself with them. So the same ISA 300 requires the auditor to involve the whole engagement team in planning the audits. Let everybody know what precedes the other. Establish an understanding of the terms of engagement as required by ISA 210. Then establish an overall strategy for the audit that sets the scope, timing, and direction of the audit, and that guides the development of the audit plan. So you should be able to articulate the timing, the direction, and have the scope so that you're able to provide that high-level planning to the team so that they understand who and who is doing what. And maybe when you go to an audit of a multinational that maybe have like 3,000 employees, one person may not be able to audit the payroll. So you can devote maybe like 5 people or more just on the payroll. You can look at another section of the financial statement. Maybe it's just investment. You could say 5 people are on investment. You could even look at revenue. How many people so where they have much revenue and there are a lot to look at. One person may not be able to all of this. So you will need to plan and allocate human resources accordingly and every other resource that may be required. So develop an audit plan, which include a description of the nature, timing, and extent of planning of planned risk assessment procedure, and plan further audit procedure. So you will look at how you are going to assess the risks with respect to the audit, and then be able to create certain procedures to which you can set up to be able to assess whether there is a material risk or not. Then document the overall audit strategy and the audit plan, including any significant changes made during the audit. So one of the typical examples of the significant changes within the audit could be the materiality threshold. Maybe the auditor would have decided that maybe 1% to 2%, 3%, or 10% of a particular item will constitute materiality. But maybe in the process, they discover that this information may not really give them what they want. They can decide to make a bigger range and say 50%, or they can even reduce it depending on what circumstance that they are able to unravel. So we are saying that at every point in time, if there are significant changes as to regards to the initial plan, document them. It's very important you document them. So you can just take this as some of the features of audit plan as required by ISA 300. ISA 300. So we discuss about the importance, and these are the typical features of an audit plan. So content of overall audit strategy, as listed out above. The overall audit strategy set out the scope, timing, and direction of the audit, and guides the development of the more detailed audit plan. Establishing the overall audit strategy involves the following. 1, determine the characteristics of the engagement that defines its scope, such as financial reporting framework, used like the IFRS, any industry-specific reporting requirement, location of the components of the entity, whether some branches are located overseas, the reporting deadline of the entity, considering important factors which will determine the focus of the audit team's effort, such as materiality threshold, the high-risk areas of the audit approach, whether to rely on the internal control or not, any recent development in relation to the industry the entity operates in. So these are some of the things that will guide the overall audit strategy, strategic plan, so to say. And this is just like having the overall knowledge of the industry into which the client entity operates. So you look at the financial reporting requirements, which of the international financial reporting standards guides the operation. If this company is operating in an agricultural setting, you should be able to know the relevant standards that guides. If it is a manufacturing company, you should be able to know the relevant standards that guides their operation. If there is any specific requirement, like there are some certain industries that have specific requirement, like oil and gas, a lot of things they are peculiar. You can't just, like even mining, the taxation, taxation of mining company is different from any other company. And so it is with every other company. So you have to understand applicable peculiarities that exist within the client company. And this will help you to give you direction as to what kind of strategy the team will use in doing the work. So the location of the entity is also very important, because there may be issue of double taxation, there may be issue of resident company, and there may be issue of branch taxation and things like that. So you have to have all this information. In fact, it might be they may even be preparing a branch account. So it's very important that you understand all these things to be able to give an overall strategy around the audit. So the reporting deadline also is very important. Even if you have not done anything regarding this, you should be able to understand that the reporting date of every entity is very important, because if not for any reason, it will give you an idea as to when they should be able to file their tax or not. So those are some of the things you need to put in perspective, so that you are able to guide the company. You are able to see that, okay, everything is being done according to expectation, and there is the risks that may come with the operation are also minimized. I've discussed materiality threshold already, so I hope to proceed now. So all outlisted above will make the auditor to determine the nature, extent of time, and timing of resources needed to perform the engagement. For example, where experienced staff may be needed. For example, in the high risk area, you may need experienced staff to be able to handle a very high risk area of the audit. That is with respect to the client's operation. Then the number of staff to be allocated to specific area. For example, more staff may be needed to count inventory at the year end. So these are things that give you direction as to how many staff you can allocate to a particular section of the audit. Then when resources are needed, for example, more staff are needed at the final audits than at the interim. How such resources are to be managed, directed, and supervised. So these are strategic decisions that the audit team lead has to make, so that you're able to appropriate the available resources accordingly to be able to provide direction and give the output as required. So audit plan. Once the overall audit strategy is established, the auditor can then develop a more detailed audit plan, which will set out the procedure to be used to assess the risks of material misstatement in the accounting records. Further audit procedure to obtain appropriate sufficient audit evidence and reduce risks to an acceptable level. So all the procedures are set out in an audit program, which are sets of instruction to the audit team as a guide to follow. So at the end of the day, it is expected that all the procedure that the auditor will use in carrying out the work are harmonized and packaged as a set of instructions, saying that auditor XYZ, you are working on payroll. XYZ, you are working on inventory. You're on revenue. You're on this and that. You're on fixed asset. You're on non-current asset or XYZ. So you evaluate this and then assign responsibility and give clear instruction to the team. Then everybody is able to carry out work in that respect, and you are able to arrive at the final and concluded report, where the auditor is able to express an opinion as regards the financial statement. So interim and final audits. Most large audits are usually split into two phases. Much of the system assessment work and transaction testing will be carried out in the interim audit, taking place perhaps 2 to 3 of the way 2/3 of the way through the financial year with the balance of the work, mostly testing of financial statement of financial position items taking place at the final audit shortly after the end of the year. So what I understand by what we are trying to say about this is that sometimes in the interim, the auditor may not be able to test everything, but a 2/3 of the financial items on the financial statement may be tested within the period for it to be able to provide a statement. Then at the end of the year, another testing is being carried out probably on the statement of financial position. And then the auditor also helped the auditor to provide an opinion, which is at the final. So for a small company, you may not see the interim reports, but for big company, it is necessary because if you do not do that, the work will be too much and it will be cumbersome for the auditor to be able to express the needed opinion on time. So you have to do an interim report, a kind of interim audit. Then you now do a final audit when the year had completed. So interim audit just mean the audit within the year. When the financial year is still running, you can carry out an audit and test some figures within the financial statement or some transaction within the year of operation. Then the final audit will now be carried out when the financial year has been concluded. That is just what we are saying here. Then the setting up of spreading the work across interim and financial audit has benefits such as more flexibility in resource planning within the firm, earlier identification of significant matters, make the audited account ready on time, shareholders and other users receive audited account earlier. It increases audit efficiency. Timing of interim audit is more flexible than the timing of final audit. This helps reduce demand for audit staff during busy session. Traditionally, the first few months of a calendar year when many clients require their financial audit to take place. So we are saying that one of the benefits or some of the benefits of doing an interim audit is that they will help the firm to be able to organize their work and maybe have their resources play around, because there are certain periods that are like free time. So there are no much work. Consider when, like in Nigeria, that most of the companies are, if you're into auditing of government accounts, you realize that almost all of them by February of the next year, almost audit is taking place everywhere because of the financial year that is almost harmonized. So if you're having this kind of off-season audits, which is the interim audit, it helps you to be able to take your time and see things through and through and make a better decision than when you have a lot of clients on you and you are trying to meet up. So it makes the audited account to be ready on time because you would have done like 80% of the work. So at the year end, you're just coming to validate what you have done and maybe do a few stuff that was not audited within the time. So these are some of the benefits of having an interim audit. The typical audit procedure include understanding the entity, assessing the inherent risks, and identifying significant matters. Recording, evaluating the design, and testing the entity system of internal control. Performing some substantive testing to ensure the books and records are intact. So these are the typical interim audit procedure, and they are not far from the final audit. It's almost the same thing you do when you're carrying out a final audit as well. You cannot do without substantive testing. You cannot do without looking at the records and evaluating them and testing the internal control system to see whether it was effective within the period or not. So typical final audit procedure would include substantive testing. In a situation where substantive testing was performed at the interim phase audits, interim phase, auditor typically tests the subsequent period between interim and year end. So you may not need to carry out a substantive testing again, but you can do a subsequent period testing and then the year end testing. At this, you are able to validate what happened after you have done the substantive testing. Then you are able to now register your opinion. Then B, test to ensure conclusion form at interim audit remain valid. So you may retest a few items just to be sure that the conclusion you form at the interim audit is still valid. The analytical review, this is where you are examining the record, you're recomputing some certain balances to be sure that what is represented or what is presented in the financial statement also conform to what you are seeing. You can go as far back as reworking or doing a work back of certain figures like purchase, cost of goods sold. You can be able to rework them out. Revenue figures, you can be able to recalculate opening balances. You can work them out again and be sure that, okay, the value presented therein are correct. In subsequent event review. So these are events after the interim audit as regards to this with respect to the subject matter, subsequent events review. We are talking about events that occur after the substantive testing. So you review them again to be sure that they are valid. The obtaining written representation regarding any matter. Written representation from who? From those charged with governance. This could be directors of the company, the audit committee, or every person responsible for giving such opinion. They will be able to write it send it in writing. The ISA 300 specifically state that the following procedure can only be performed at or after the period end. Agreeing the financial statement to the accounting records. Examining adjustments made during the course of preparing the financial statement. So this is according to IS 300 that this too must be done after the period. So understanding the business and materiality, kindly check IS 250, 315, and 220 for more insights. The objective of auditor under IS 315 is to identify and assess risks of material misstatement, whether due to fraud or error, through a thorough understanding of the entity environment and its internal control. Auditors should then look for factors that could be significant and to which particular attention should be given by the audit team. So we are just talking about assessing material statement. You are very sure that you have identified those items in the financial statement that could cause a material misstatement as a result of either fraud or a serious error. For example, auditor may be aware that there is a recession in the industry in which the client company operates, and the rising prices of commodity may, have made the company to raise their product price, and and so pass on the high cost to the customer. Another example is that when a company has a poor track record of trade receivable, this might make the auditor to focus his attention to the measurement of trade receivable and estimate of bad and doubtful debts. So what we are saying is that there are indicators that may point to you that these are some certain areas in the financial statement that require more attention. This could be around your receivables. This could be around your prices. There may be one reason or the other that would have triggered something within the industry, and the auditor may pick interest in a particular matter and study the nature. Like, for instance, if you're auditing a hospitality business in Nigeria, within from 2023, from May 2019 now, you would understand the frequency to which these guys change their room rates. It could be a trigger, it could be a red flag for you to be able to check that things may not be okay. And they will tell you that, yes, the price of diesel and this is this. So within a month, you can see that there are 3 different prices. Hospitality industry. If you're there, you know what I'm talking about. I'm just giving an example. So there could be a trigger that you, as an auditor, will give you a sense that you say, okay, I need to check this, I need to check this, I need to check X, Y, Z. So by the time you're able to join the lines all together, you're able to come up with a conclusion based on satisfactory evidence that, yes, this and this exist or not. So IS 310 require auditor risk assessment procedure to include the following: inquiries from management and others. So you can inquire from those charged with governance, which is management, and every other responsible party whom you suggest, whom appear to be responsible on the subject matter. Then observation and inspection, like internal control. So you could, if it's a manufacturing company, you can just go to the production site and observe the way the product is being produced from the first point to the bagging point. You're able to see the process and ensure that, okay, there are no wastages, everything is done as specified in their standard operating procedure. So you can as well do this by just going to the internal control session and see how things are being run. You could ask the guy to log into his computer. You just observe the way he does his things, and you take your report and move. So those are some of the things that you do. Then analytical procedure like ratio and trend analysis. So like I said, you can recompute certain ratios. But it is the duty of the management to prepare the financial report. So you're just there to confirm. You can recompute them. By that, you're doing analytical procedure. You can analyze different balances on the financial statement. It could be bank balances. You can check them. They will provide you with a list of their banks and their bank statement. So it is your duty to be able to reconfirm that, yes, the balances existing in their account, in their cash book, and the balances in their account as to their bank statement correspond or not. So those are some of the things you can do. There are varieties of activities you can do to be able to arrive at this procedure. I'm just giving you an example. It could be your opening balance, it could be revenue, it could be any item on the financial statement that attract the attention of the auditor. So with this, auditor will be able to identify any significant changes between previous and present audit and know whether audit plan or approach used last year will be appropriate or not. So that is why most times you would say that the financial figures are presented in a comparative form. That is the figures of last year and the figures of this year. So the last year period can be able to give you an idea of what this year will be. And that can also be a way of informing the auditor that the last year's strategy need to be changed and the auditor will adopt a more appropriate plan for the audits of that particular year. So talking about materiality, IS 320. Materiality is a fundamental concept to auditing and accounting. It reflects the fact that users of financial statements find statements useful even if they are not 100% accurate. Financial statements will only be useful if they do not contain material errors or misstatement. Therefore, that materiality concept is very, very important to understand. So, materiality concept is very important for you to understand what it is. You can only be able to describe it and be able to state all that it requires if you have a full grasp of it. So you should understand that materiality has to do with the impacts that will happen or will make or will cause the whole work to look like or to be perceived. So we are saying that if something happened that magnitude within that radius, it will affect the financial statement. It will not be what it's supposed to be. So that is when we can say that something is material. So understanding of materiality concept is very important. And for you to understand this, we are just saying that it is something that when misrepresented will cause a misinformed decision from any user of the financial statement. So based on the IASB framework for preparation and presentation of financial statement, that is IS1, information is material if omitting or misstating in it could influence the economic decision of user taken on the basis of the financial statement. So if their omission or their misstatements in the financial statement could influence the decision of any user. So if you misstate them or you omit them in a financial statement, we misdirect anybody that is using that financial statement to make an economic decision. Then we can say that item is material. I don't want to speak too much there, but maybe when we describe it, you'll be able to see there are more description. Thank God. This is a summarized note, but there are still flesh to it. So at the start of the audit, that is this planning stage. This can be done by setting materiality threshold. Thus, you could set a revenue 1 to 2%, meaning items of revenue is material if it represents at least 1 to 2% of the annual sales or turnover. Then you could take such items and say that, okay, yes, they are material. Just a moment, I need to take some water. All right. All right. So you could say that if an item of revenue from 1 to 2% may constitute a material item in the financial statement. So in that regard, you'll be looking out for any item of such, and you will want to check them more to probe them to be sure that they are coming into the financial statement does not have a problem, that it is well captured, that it fulfills all the requirements, and the value, it is a correct one. There are evidence that such sales were done and money were collected and recognized in the financial statement. Then you could also set up a threshold and say that pre-tax, that is profit before tax. If the item are all to any item that culminate to that profit before tax is up to 5%, then you would want to check them. And you can go ahead and you could also say total assets. Any item that constitutes 1 to 2% of total assets, you would want to probe them to be able to confirm their accuracy and completeness of the process to which they came into the financial statement. So what we are saying here is that materiality threshold, setting a materiality threshold is not a static exercise or assignment. It is dependent on the client context and the volume of transaction and the peculiarity that exists within the client company that the auditor is looking into. Then, during the audit, materiality may be reassessed to various reasons. For various reasons, the auditor might choose that originally, at the start of the audit, profit figure is used, but during the audit, profit is not right figure for use or change the percentage range. So the auditor may decide that you are going to check the profit figures, but during the audit, you will now discover that no, the risks inherent to that audit is not with profit figures. So you will decide to pick up another item. And remember, we have said before that one of the features of this is that you should document all changes done in the cost of the audit. So you can redirect your focus of materiality and look at other items, just to be sure that there is no material risk and all the figures that came into the financial statement are correct, accurate, and are supported by a complete documentation. Then, at the end of the audit, add up all material mistake because overall it might be material. So if at the end of the audit, you will now aggregate all the items you suspect that were misstated in the financial statement and check again to reconfirm whether they could form a material issue around the financial statement. Then performance materiality. This is set up for specific individual item at a lower figure than overall materiality. So it could just be looking at maybe in a manufacturing company, you have 5 lines, different products, and you want to see the performance of each of them. Then you could set out specific procedure to check the performance of those products and see how an item therein can affect the financial statement. So this is not done like you would have done it in 3 above. This is done on individual items. So you can pick up a figure just to check and know whether a particular product is doing better than the other or whatever it is. Each time auditor spots a non-compliance, he can report it to those charged with governance, the authorities, or in the audit report. You can also include it in the audit report. So we are saying that it is very important that every company complies with the laws and regulations as specified by ISA 250. So it is the duty, the auditor has a responsibility to bring any item of non-compliance to the knowledge of those charged with governance. That could be the board, it could be the directors of the company, the authorities, that is the body responsible for regulating that company. Then you could also indicate it in the final report so that users are aware of issues that are therein with the company. The audit risks is 330. This is the chance that the financial statements are materially misstated, but opinion says they are truth and fair. I think there is a mix-up there. This risk that the auditor gets the opinion wrong. So there is a risk that the financial statement may have been presented well. However, therein, the opinion, therein there are material misstatements that the auditor is unable to see. That the auditor is unable to see and has issued a wrong opinion as regards the financial statement. So this is an audit risk. So there may be packaging that the auditor may not be able to see and will go ahead and issue an opinion. So this is why you are not going to base on one to study or to do one type of risk assessment. There are varieties of risks, and we're talking about the audit risks, the general audit risks now. What and what form the audit risks? We're talking about the inherent risks, that is the risks that come with the company, the nature of the company, the industry the company operates in, the staff of the company, the internal control, the way things are done generally in that company, the risk that comes with it. Then the control risks. How is their internal control? Is it effective or ineffective? Then detection risks. What are there in the financial statement that the auditor may have not been able to detect? So those are all the items that form the audit risk. Where inherent risks and control risks are the risks of material misstatement. So the control risks and inherent risks may be the cause of material misstatement, which the auditor may not see. And this will become an audit risk because the auditor is not able to come across such material misstatement and is not able to redirect his opinion. So whatever the opinion the auditor is giving at the end of the day may not form the basis to which someone could rely upon to make an informed or economic. Then inherent risks, that items are misstated due to the nature of the company, the industry it operates, and some items in the financial statement. In practice, this can happen at two levels. At the level of financial statement, items are considered to be, that's the nature of the business and industry, the integrity and skills of the management. So we are saying that the inherent risk can happen in two aspects. The nature of the industry can also be a problem, and maybe the complexity that exists in the industry can make company have this kind of a risk. Then the integrity of the management, whether there are people who do things right or there are people who just are able to cook the numbers and put them there in the financial statement. Then the quality of staff, that is the skills of the management, how knowledgeable they are about the subject matter, and also be a thing of concern. Then at the account balances level, the auditor considers the degree of subjectivity involved in account balances and transactions. So sometimes they would have maybe migrate their accounting system and they would have lost some balances that they have to estimate them. So at that point, you have to use best judgment to be able to estimate those balances. So subjectivity is very important. You have to examine how they were objective in that. Then degree of complexity of transaction. I've talked about complexity of transaction as well. Then characteristics of client assets. The nature of the client assets has to be understood as well. Then control statement are materially. So if the internal control system is very weak, then I suppose there will be a high risk that the financial statement that pass through it or it's produced from that same weak internal control will not be free from material misstatements. Then detection risks. Risks that auditor testing procedure will fail to detect a misstatement in the transaction or an account balance. So there is a risk that the auditor testing procedure may not be too effective to be able to uncover a particular item, especially where the audit is not carried out for 100%, where the auditor use sampling procedure, for instance. There is a possibility that some items may not be covered. So, okay. Are we rushing this chapter? I want to break here and see if you have a question.
Good evening, sir. Sir,
Good
please,
evening.
which chapter in the of the outcome part are you teaching?
We are teaching
Chapter what?
chapter 5, audit planning and risk assessment.
All right, thank you, sir.
Any other question? Okay. So we're talking about business risk versus financial statement risk. So most business risks
Hello, sir.
has a direct link to risks that financial statements are wrong because risks increase the
Sorry, sir.
likelihood that financial statement will be misstated. For example, okay,
Hello, can you hear me, sir?
I can hear you.
Okay, sir. I've tried to raise up my hand, but you're not saying. So my question is the word and those charged in governance. I
Yes.
really need clarification on it. Is it the auditor or the management, the clients, which we are auditing as an auditor, or the shareholders who owns the company? So who is those who are in those charged with governance? I do see that statement, but I really don't know who that statement belongs to. Is it the auditor? Is it the management? Is it the shareholder? I don't really know.
Okay. So thank you for your question. So when we're talking about those charged with governance, we're just talking about corporate governance, right? Do you understand what is called corporate governance? Have you heard that word before?
Yes, sir. Yes, sir.
Okay.
Yes,
So
sir.
when we say corporate and we say governance, we're just talking about those who are presiding over affairs of the company. That is just the definition of
Okay.
corporate and governance. So when we say those
Okay.
charged with governance, we're just talking about those who are responsible for running the activities of the business. They could be
Okay.
CEOs, they could be COO, they could be CFO, They could be whatever. Do you
Okay.
understand?
Okay. Yes. Yes.
So we're talking about the executive, the management.
Okay.
So those are those
Thank you.
with governance. So why we are saying this is that you know that shareholders are the owners of the business, isn't it?
Yes. Yes. You are correct. Yes, sir.
Yes. But for instance, now let's take Zenith Bank or First Bank, for instance. If all the shareholders of Zenith Bank or First Bank will want to come together to work as the staff because they are the owner of the business, do you think they will have space to sit?
No.
There will be no
No,
seat for
that's
them.
not
So
possible.
they have directors, they have chairmen, they have CEOs, they have branch manager, they have those who are responsible in one aspect or the other. In fact, they have audit committee, they have auditors, they have this and that. Everybody is responsible for one part of the business or the other, isn't it? So they have been
Yes.
charged with governance of the business, and they are subject to reporting to who? The shareholders, because shareholders
Yes.
are the owners of the what? Of the
Of
business.
the business.
But they have charged the governance to outsource the governance to certain individuals, and they pay them.
Okay.
Do you understand?
Thank you.
Remember in
Yes, sir.
chapter 1, when we talk about the principal and the
Agents.
what? The
Agents.
agents. Yes,
Yes.
you remember that very well. So this is what we say when we say those charged with governance. We're just talking about who are the people running the company. Like I gave you the
Okay.
definition: corporates and governance.
Yes,
Corporates.
I get it.
Corporate. Corporate means company. Governance means administration or management.
Mm. Thank you so
You
much, sir.
understand that, right?
Yes, sir. Yes, sir. Thank you so
All
much.
right. That's fine. You're welcome. So, understanding bad debts or allowance for doubtful debts. Overstating the value of inventory where net realizable value is less than cost. Overstating the value of non-current asset due to failure to recognize impairment. Overstating revenue, understanding liability and provision, wrong accounting estimate, failure to comply with the requirements of accounting standard. So we're just giving you some of examples of business risk. Yeah. For example, your client sells electrical goods with 1 year guarantee. During the last 3 months of accounting year, items returned faulty by customer have increased substantially. Required. What are the business risks and the risks of material misstatement? And they provided the answer here. They say risks that customer will buy from other company, meaning client sales revenue will fall. You understand? So because there has been return of maybe defaults in the malfunctioning or something, and people are returning the goods. So it means that this information will reach out to other customers and they may not want to buy from that company. So there's a business risk that customer would want to buy from other companies, and the revenue of the business will drop. Then the cost of repair and replacement will rise, leading to a fall in profits and going concern problem. So we are told that business is expected to run in perpetuity, and this means that the business will keep on making profit for it to be able to sustain itself. So by the time you are using all the profit to replace item already sell to the markets, or even maybe probably repair them, this means that the profit would keep eroding and a going concern of the business will also be questioned. So risks of material misstatement. In answering this question, the following techniques will assist. What item of financial statement is affected by this? Whether over or understated, or the reason why. So you have to consider what are the items that would have cause the financial statement to be materially misstated? The answer: revenue is at risk of misstatement because some customer might cancel their purchase post year end and demand a refund due to quality problems. So you would have already recognized certain sales in your book and account for them as revenue, and ultimately increasing your profit within that year. And at the end of the day, you now discover that the customers are making refund, are returning certain items and are claiming refund. Then it could make the financial statement not to have presented the same statement that it was in the previous year. Again, also inventory at risk of overstatement because 40 items are likely to be in warehouse at the year end, and they might get value at cost, even though net realizable value is probably lower or might be zero if products is unusable. Whereas IS2, that is inventory, require inventory to be measured at lower of cost or net realizable value. Also, provision for warranty repairs will be understated if this year's estimate provision fail to take account of the recent increase in returns. So these are the items that were here to make the financial statement to be materially misstated. Then fraud and error. According to ISA 240, fraud is defined as intentional acts involving falsification of records or documents, deliberate incorrect application of accounting policies, misappropriation of assets and fund, falsification of records or document, deliberate incorrect application of accounting policies, then misappropriation of assets and funds. This is so straightforward that you do not need any explanation. Error is an unintentional misapplication of accounting policies, oversight, or misinterpretation of facts. So it is very important for you to understand error and fraud. For fraud, we are saying that something is deliberate. You're doing it intentionally. It's an intentional act. You know what it is, but you choose to do it to suit a particular outcome that you desire it to be. So you're forcing the record, you're increasing the revenue. Maybe in Nigeria, sometimes you discover that someone who wants to take a loan, they will ask you to do a financial statement. They will tell you they want a financial statement to go to the bank with. You say, okay, let me see your bank statement so that we can help you out. You see that the bank statement, the highest amount there is 20,000 naira. And they want you to make it 20 million. How do you do that? How do you do that? If you have done that, it means that the financial statement presented is, the information presented there is not correct. And this could amount to falsification of records. And this is also could be the kind of deliberate incorrect application of information because you're supposed to state it the way they are. So I think I'm going to stop here. I'm going to stop here. My voice is cracking. So the next lecturer will start from here tomorrow. This will be page 36. So you just round it up, this up, and start the new chapter. So if you have your questions, please, you can send them in. I have 10 minutes for that. Then we can call it a night. Thank you. You don't have questions, we can close.
Hello.
Yeah.
Okay. Good evening, sir. My question. Okay, my name is Eric. My question basically is, can you hear me?
Yes, I can hear you.
Okay, my question is how we can um I understand the whole planning to be able to overcome the risk.
Yes.
I want to know the procedure of identifying those risks in the first place.
Please repeat your question, please.
I mean, like you stated a planning procedure, right?
Yes.
I want to know if there's also a procedure to identify the risks in the organization that we are auditing.
Okay. Which of the risks are you talking about?
Like the inherent business risks.
Okay. So when we talk about a business risk, we're just talking about the things that could happen, that could happen, that could influence the outcome of the financial statement. You say most business risks has a direct link to risks that financial statements are wrong, because business risks increase the likelihood that financial statement will be misstated. So that is why we are saying that you should be able to make a procedure that will help you to check, for instance, your bad debts or allowance for doubtful debts. Do you understand?
Yes.
So if you're able to check, maybe you can also check value of inventory. You can be able to compare them with current market price.
Okay. Okay.
Then overstating the value of non-current assets. So you have to check them against payment to be able to know that, okay, the actual price that they have is actually what should be carried out, to be recognized in the books. Then you should also check your revenue. So at the end of the day, for business books, I can tell you that if the auditor plans his work very well and is able to carry out his work well, this business risk would have been eliminated.
Yes, okay.
Because you would have done your review around materiality threshold. You would have tested all the figures, items of inventory. You would have done verification of items. You would have tested for impairment. You would have checked for liability and provisions made. You would have checked for wrong estimates. So all of this put together will be able to tell you that the business may have not existed. You understand? So this is what we are saying. So for business risk, we are saying that it is those items that if they are not checked, they will pose a risk on that financial statement that it will be materially misstated. So I don't think you may have a specific procedure, but I believe that if the procedure which we have highlighted in above, based on materiality check, checking the auditor, the audit rates, the inherent rates, the control rates, the detection rates, if you check all of those, then you would have knocked off the business risk. And that is why it is coming last. So if you have done your work very well, you would have been able to eliminate the business risk. Because business risk to some extent, it look like inherent risk if you look at it very well. Because we're talking about the scales of the the management, how truthful they can be. So if they know what they are doing, wrong accounting estimate will not be an issue. Understating liability and provision will not be an issue. Overstating revenue will not be an issue. Overstating the value of inventory will not be an issue. Do you understand? So any other question, please? Okay. In the absence of any questions, this
I
is
have a question, sir.
okay. Okay, go ahead.
Sir, please, for better understanding, I just want to
Okay.
know,
Okay.
the external auditor, what is their
Yeah.
function to the company, and the other internal revenue and federal internal revenue, they also carry out audits. Are they the same with the external auditor for the book of the organization? Is it the same audit the state internal revenue also perform? And what is the difference between those
Okay.
two, those bodies? Yes, when they say, state internal revenue are coming for audit, what are they looking for? What should the accounts department or the finance department, what should they put in place? How should they set their record? What are those things that those state internal revenue are coming to check? And if it is federal internal revenue, when they say, they are coming for audit, they want to, what are they coming to check? And likewise, the external audit. So I just want to have a clearer view of this, because I'm having some mix up when you hear audit. So thank you, sir.
Okay. Thank you for your question. So basically I will tell you that the internal revenue, board of internal revenue, whether they are federal or they are states, they are not really your auditor. They are a regulatory body, they are a compliance body. So when the tax authority come to you, they are concerned with tax. Like the federal internal revenue, when they come, they are concerned with your withholding tax, your capital gain tax, your income tax. How have you been complying with all of those things? When the state internal revenue comes to you, they are concerned with employee tax, that is the payee. How you remit them, how you withhold, you pay your payee of staff. They are checking your payroll to be very sure that you're paying the appropriate rates that the laws require you to pay. They want to check to know that you're paying your office rent. You're also remitting it to the state to which your business is located. So just like I said, when the Federal Revenue Service come, they are checking your withholding tax, they are taking your income tax, they are checking your, which one again? Your, yeah,
VAT, capital
everything
gain.
that concerns tax. So they are checking tax complying with all the taxes that you are required to withhold and pay to the body. But when we are talking about the internal auditor, we're talking about the auditor, we are referring to the statutory auditor that is required by law according to CAMA 2020 as amended. CAMA requires that all companies in Nigeria, and in fact, in the world, almost all the countries, if you remember, when we go to that charter, you remember, I told you guys that it is required by law. Oh, that should be for the last diet. It is required by law that all companies appoint an auditor at the end of the year to check their books and pass an opinion as regards to the operation of the business, as to whether the business, the financial statement present a true or fair view. So tax auditor is a regulatory body, a compliance body that come to just check your book to be sure that yes, you're following what the law to which you're operating asks you to follow. Then the auditor is you that will hire the auditor. You do not pay tax auditors. You do not pay Federal Revenue Service auditor when they come to check your tax book. You don't pay them. But the auditors, it is expected that their audit fee will also form part of your expenses in your financial statement. So you pay them to come and check your book to see that whether what you have been doing, it is correct or not. So the difference here is that you are the one, it is your shareholders who appoint your auditor. But the tax auditor are auditors from the government. They are acting on behalf of the government. So the Federal Revenue Service is acting on behalf of the government of Federal Republic of Nigeria to ensure that yes, you are a responsible company. Remember that we recognize company as human being in the eyes of the law. So you are a responsible person. A company is a responsible person who is a law-abiding company that is paying tax. They will tell you that it pays to pay tax. It is with your tax that the government used to provide electricity, to provide water, to provide roads. So you have a responsibility to be able to pay the appropriate tax that is required of you. So that is why you see those guys from FRS come to check your books. That is why you see those guys from IRS to come to check your book. That is State Internal Revenue Service. It could be that of Lagos, it could be that of FCT, it could be that of Delta State, it could be any states. They will come. They will always come to check your books. So it's just for them to check and say, yes, you're complying with the Constitution of Federal Republic of Nigeria. That's all. Because the FRS is set up by the law of the Federal Republic of Nigeria, while the state revenue services are set up by the laws of the states, respective states. So I don't know whether you
hello,
have
sir.
got it.
Hello,
Thank you very
hello,
much,
sir.
sir.
Is it clear?
Yes, sir. Yes, sir.
All right, thank you.
Hello, sir. Can you hear me, sir?
I can hear you.
Yeah, but to me, I feel that when we talk about the FRS and state internal revenue that came for the audit, I feel that they are also an external auditor, but in different category.
They are not
Like
external
I mean,
auditors because you do not appoint them.
They are never an auditor. They only come
They
for
are
tax.
never
There
an
is no
auditor.
reason why they are here than tax.
If you
They are
join
only for
them, they
tax
are
purposes.
never an auditor. You never appoint them. They are compliance agents from the government.
okay.
Hello, sir. I have a question, please.
Go ahead, please.
Okay, sir. Regarding this question that was asked, so I got the explanation. So my question now is the external auditor. If a company has an external auditor, is there need for them to still have internal auditor? If yes, if they do have internal auditor, okay. If the external auditor now come, does he audit the internal auditor or audit every book of the accounts of the company, or they work together to audit the book of the company?
So the auditor, so if you look at the independence of the auditor, the external auditor is independent, but the internal auditor is not as independent as you may think because it is hired by the same company and is answerable by the company. But the external auditor is not answerable to the company. So outsiders may not be able to regard the report of the internal auditor against the report of the external auditor because of the independence issue. I don't know if you understand that.
Yes, sir. Yes, sir.
So for that singular reason, external users of financial statement may not be able to rely on the work of internal auditor alone to be able to make a firm decision. But for external auditor, like the Big Four now, you cannot control them. When they audit you, they will tell you what is in your financial statement. They will just tell you the picture the way it is. But for your internal auditor, when he audits you and he makes noise, You just tell him that, Uncle, I will not pay you next month. And he will change it to what you want him to change it, isn't it? It's possible. Because he's not independent in that perspective. As much as you may think he's independent, he's not. And the internal auditor exists actually to ensure that the company is going in the right direction. So the work of the internal auditor is to advise. It's a policeman that is able to help the company staff to do things the right way. If you're an external auditor, you should be working with your team to advise them to make sure that they are complying with what the external auditor will come and pick. So it's not for you to come and be claiming that you're an auditor, what are you auditing? Your work is to help the people you're working with to make sure that they are working according to standard. So to make sure that the internal process of doing things is being followed, you monitor and advise. So you present the report to management and tell them that, okay, we are lacking in this, you make recommendations. You could go to a department and you say that maybe staffing is an issue and probably the quality of work is not up to expectation. An internal auditor can write and recommend to the management that, okay, we need to improve also aspect of our operation so that we can have a better quality work. Do you understand? So the work of an auditor cannot be compared with the work of an external auditor for a singular reason. Their independence is not the same. In as much as you are going to pay the so that is the difference. Any other question? Okay. We should please